All right, welcome to this explainer. Today we're taking a seriously dense piece of the Indian Income Tax Act and just completely demystifying it for you. We're zeroing in on Section 44 ADA. If you're an independent professional, understanding this specific framework isn't just mildly helpful, it's a massive game changer for how you manage your finances and, honestly, your time.
Because let's be real here. Are you totally exhausted by complex tax bookkeeping and endless receipts? Storing every single coffee receipt, logging every minor office expense, and just dreading that administrative nightmare of traditional tax filing is a huge burden. It's a massive headache for independent professionals who really just want to focus on their actual work, not on acting as their own full-time accountants.
Okay, let's dive right into this. Here's our agenda for today. We'll cover what Section 44 ADA actually is, who's eligible, the 50% profit rule, the digital payment exception, what happens if you claim lower profits, and then we'll wrap up with our final takeaways. Section 1. What is Section 44 ADA, the legal shortcut for professionals?
The actual legal text of Section 44 ADA, straight from the official source material is, well, dense, isn't it? It's completely packed with legal jargon, subsections, and provisos that can easily make your eyes glaze over. But hey, don't worry, you absolutely do not need a law degree to get through this today. We're going to translate this intimidating wall of text into plain, actionable English.
At its core, Section 44 ADA introduces something called presumptive taxation. By definition, this is a special legal provision that allows professionals to declare a set percentage of their gross receipts as deemed profit, completely bypassing the need for exhaustive bookkeeping. Think of it as the ultimate shortcut offered by the government to just simplify your taxes. Instead of proving every single expense to arrive at your final profit, the government simply presumes your profit margin for you. Pretty cool, right?
Section 2. Who is eligible? Identifying the beneficiaries.
According to the statute, this scheme is specifically designed for a select group. To qualify, you got to be a resident of India. You can be an individual or a regular partnership firm. You also must be engaged in specific professions listed under Section 44 AA1 of the Act. So this typically includes legal, medical, engineering, architectural, or technical consultancy, among a few others. But listen up, because here is an absolutely crucial exception. Limited liability partnerships, or LLPs, do not qualify for this scheme. If your business is structured as an LLP, you are legally and explicitly excluded from using this presumptive shortcut.
Section 3. The 50% profit rule. The math behind the magic.
The first major number you need to memorize from the legal text is 50 lakh rupees. To qualify for the standard presumptive taxation scheme under Section 44 ADA, your total gross receipts in the previous financial year must not exceed 50 lakh rupees. That's your standard operational ceiling.
And here's the crucial point, 50%. If your total receipts are under that 50 lakh threshold, the law allows you to declare a flat 50% of those gross receipts as your deemed profit. You literally just cut your top-line revenue number in half, and bam, that becomes your taxable business income. No itemizing expenses, no saving every tiny receipt. It's that simple.
Now you might be wondering, wait, what about my big business expenses or the depreciation on my expensive work laptop? Well, the law is super strict here. Deductions under Sections 30 to 38 of the Income Tax Act, which includes depreciation, are legally deemed to have already been given full effect. This means, because you're taking the 50% shortcut, you cannot claim any further business deductions at all. The written down value of your assets is calculated as if you had already claimed the depreciation. It's all just baked right into that initial 50% package deal.
Section 4. The digital payment exception. Rewarding the cashless professional.
Now, what's really interesting is how the law rewards digital transactions. The government added a special proviso to this section. They introduced a strict 5% rule. Basically, to unlock the higher benefits of the scheme, your cash receipts absolutely cannot exceed 5% of your total gross receipts for the year. That means a minimum of 95% of your revenue has to be received digitally or directly through the banking system.
And this brilliantly illustrates the massive benefit of that digital exception. The standard limit for gross receipts, as we just discussed, is 50 lakh rupees. But if you meet that digital payment proviso, keeping your cash receipts at 5% or less, your gross receipts limit jumps all the way up to 75 lakh rupees. That is a massive 25 lakh rupee expansion of the eligibility ceiling, purely as a reward for operating a clean, cashless, digital business.
But watch out, because here is a surprising and critical legal gotcha found right in the fine print. An account payee check or an account payee bank draft? Perfectly fine. That's a valid digital receipt.
However, the law explicitly states that if you accept a check that is not an account payee check, it is legally deemed to be a receipt in cash for the purposes of that 5% limit. So, a simple oversight in how a client writes a check could accidentally push you over your 5% cash limit and cost you that entire 75 lock tier.
Section 5. Claiming lower profits. The consequences of opting out.
So you might look at the 50% rule and think, hold on, my actual profit margin is only like 30%. I spend way more than half my revenue on legitimate business expenses. So what actually happens if you formally claim your actual profits are lower than the 50% deemed by Section 44 ADA, assuming your total income is above the basic non-taxable limit?
Well, if you step outside the 44 ADA shortcut, you trigger some incredibly rigorous legal requirements. Step 1. You're now legally required under Section 44 AA to keep and maintain exhaustive books of account and all the supporting documents. Step 2. You must get those accounts formally audited by a chartered accountant and furnish a comprehensive audit report under Section 44 AB. Walking through these burdensome, expensive steps proves exactly why the Section 44 ADA scheme is so highly valued. Avoiding this mandatory audit is literally the exact reason the presumptive shortcut was created in the first place.
Section 6. Final takeaways. Bringing it all together.
Okay, here's your concise, energetic recap of the critical legal mechanics we've covered today. First, Section 44 ADA allows you to declare a 50% deemed profit, entirely replacing the need for heavy bookkeeping. Second, the standard gross receipts limit to use this scheme is 50 lakh rupees. Third, that limit generously jumps up to 75 lakh rupees if your cash receipts are 5% or less of your total revenue. And lastly, if you decide to claim less than a 50% profit margin, you've got to maintain exhaustive books and you will trigger a mandatory formal audit.
Which leaves us with a pretty provocative thought to reflect on today. Is the stress, the time, and the accounting fees of maintaining exhaustive books of account actually costing you more than your actual tax bill? Sometimes the simplicity and peace of mind offered by presumptive taxation isn't just a convenient legal shortcut. It's honestly the most profitable choice you can make for your own sanity. Thank you so much for joining me on this explainer. Keep learning, keep optimizing, and we will catch you next time.